Hi there. Welcome to the Open here on BNN Bloomberg. I'm Lindsay Biscaya. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. U.S. President Donald Trump says strikes against Iranian energy infrastructure and power plants would be postponed for 5 days following the start of talks with Iran to end the war. Trump also says the halt to attacks are subject to the success of the ongoing meetings and discussions. Trump had initially given Iran until this evening to reopen the Strait of Hormuz, or the U.S. and Israel would start bombing the country's power plants. An Air Canada Express plane with 72 people aboard collided with a fire truck shortly after landing at New York's LaGuardia airport last night. The 2 Air Canada pilots who were flying the plane died on impact. 41 people were taken to hospital, with many in serious condition. And Air Canada says it is cooperating with the Transportation Safety Board of Canada and the National Transportation Safety Board in the U.S. in the investigation. Berkshire Hathaway is investing $1.8 billion U.S. in Tokyo Marine Holdings, expanding its presence in Japan's financial sector. The investment was made through Berkshire's National Indemnity Unit. The investment will give the firm a 2.49% stake and will establish a strategic partnership spanning reinsurance and global deal-making. The agreement includes a 10-year collaboration and limits on competing partnerships in its early years. Okay, we'll take a look at the U.S. futures to start the morning. Stocks are rebounding today, bonds as well, after this news from U.S. President Donald Trump saying that talks with U.S. and Iran are going well and that he is postponing planned airstrikes on Iranian energy infrastructure. You can see the Dow is up by almost 2%. The Nasdaq is up more than 2%, and the S&P 500 up 1.8%. We're also going to be tracking the TSX carefully today. It had a pretty rough week last night, basically erasing all of its gains that we saw since the start of the year. So we'll continue to watch today and see if there's a rebound on the TSX as well. So as you just saw, stocks and bonds are getting a lift today after U.S. President Donald Trump said the U.S. and Iran had very good conversations regarding the end of the war. Our next guest says the conflict has challenged the narrative of precious metals and crypto as a safe haven. So let's get more now from Dan Rahinton, portfolio manager at IA Global Asset Management. Dan, good morning. It's good to have you join us.
Good to see you.
So why do you think that this has really been challenging that narrative so much of these safe havens?
Yeah, well, what's interesting about the gold narrative has been, and silver as well by proxy, has effectively been it's a safe haven, but they're also, the trade-off you take as a precious metals investor is 0% yield, right? Because gold doesn't pay an interest. So when you see higher interest rates from the Iran-US conflict, pushing interest rates higher further and further, then the allure of the shiny metal actually decreases on the back of it. And what's important to say in this conversation, and we've had, I call it little whispers of this discussion, past times we've discussed this, has been around the idea that there's a lot of leverage, there's a lot of speculation, and that has just compounded the price move. So you could argue gold's a little overdone from where we are, but the underlying catalyst has been the belief that the safe haven narrative is fully played out. From here, the higher interest rates are actually hurting gold and silver quite disproportionately. And then you take Bitcoin as a separate discussion where actually higher energy costs make mining more expensive. But this also means that the Iran conflict pushes any stable coin and other legislation related to, call it democratizing crypto in the U.S. economy, put further back. So you're seeing gold and Bitcoin and silver act as risk-on assets when historically they've been more risk-off in their structure.
I know it's been so interesting to watch kind of the trickle-down effect as well, because as you mentioned, gold had its worst week since 1983 recently, basically erasing all of its gains from the beginning of the year. And that's something similar to what we saw in the TSX last week as well, which is really reliant, obviously, on a lot of gold and mining stocks. Like, do you see that kind of connection as well?
Yeah, 100%. The TSX has seen a huge increase in how much more precious metal sensitive it is, and which is ironic because it's also a big energy index too, and energy stocks have done really well given just how much higher oil prices are. So the TSX is a bit of a yin and yang type of index versus the technology index, which is really the S&P 500. So I think there's a bit of a push and pull here. On balance, I think it's probably the TSX from here is a little oversold, but at the end of the day, it's also been a very strong past year as well. So you got to take that into account.
Yeah, for sure. Okay, so let's talk about oil a little bit more and the situation in the Middle East. Obviously, we're seeing the price of oil dropping today. What's interesting, though, is we've heard the comments from U.S. President Donald Trump. Iran media, though, denying contact with Trump, saying that Trump retreated after hearing Iran's next round of targets would be power plants in West Asia. What are you taking from everything we're hearing right now and from what we're seeing reflected in the markets?
Yeah, I think there's two things just to think about, just as a general way of how how negotiations happen in this type of conflict. The first one is that the domestic audience for Iran is more important than the foreign audience. So saying that you're negotiating with the United States is not going to be acceptable in any scenario. So this has always been back channels with Iran denying whatever is happening, because you're focusing on your own domestic audience and making sure you give the illusion that you have complete control. So I think it's important to say whatever the U.S. says is probably a bit more credible than what the local Iranian media will say. That being said, I think it's important just to think about this. There's a theory in warfare called escalation dominance, where who has the right to escalate more and more. I think what we really are seeing, if we really take a step back, we're not seeing strikes on critical infrastructure, which is desalination plants in parts of the Middle East, power plants, critical things that will take a long time to come up and have real enduring harm to a lot of people. So the fact that we're not going down that road does not mean that the conflict is given that it's over. It's more just the extreme outcomes are being priced down a little bit. So is this the start of, and what tends to happen sometimes is this is the start of a path towards a truce? I would say that's maybe a bit of a leap so far. So just because you're not bombing the power plants around the country and bombing desalination plants does not mean that we're clear skies ahead. But I think taking a step back from where we are in the market, seeing a 2% rally intra-hour effectively on the headline tells you that there's a bit of a coiled spring effect where the market has been selling off on this. So any positive news reflexively gets bid quite aggressively.
And I take your point. Anything that, Iran media, the regime says, does have to be taken with a grain of salt. But Iran is also saying that Hormuz won't return to pre-war state even after this is over. So I'm wondering what you make of that. Like, if this is to start to wrap up, where do we see things going?
Well, I think when you think about just sheer trade flows, call it liquefied natural gas, oil, other petrochemicals, and fertilizer as well, it has to come back to normal because there's too many people that are exposed across Asia Pacific and parts around the Indian subcontinent. Think Pakistan, think Indonesia, think Japan, Korea, so on and so forth. So trade flows will open to some normalized effect, whether it's by negotiation or by sheer force of will. That's more of a question of when, not an if. And most parties would be on side with that. So whether this is a negotiated back channel agreement or whether this is a military forcing open the strait with overwhelming force, I don't know the answer to that question, and it's really not our place to judge. But you have to assume that there is a normalization in a reasonable period of time.
Okay, so before we move on from this, then I'm assuming, I'm asking you to predict the future a little bit, but obviously we're going to see probably some volatility continue in oil.
Yeah, and I'd expect volatility in the rest of the market too. So oil prices going higher is effectively a income shock to other parts of the economy. So it's been a while since we've had this conversation, right? It's been years actually. But when oil prices go up, it tends to hurt consumer incomes, basically because you're paying more for gasoline and other food costs and things like that. So it tends to have a bit of a dampening effect on sentiment. Then the central banks react and they don't cut rates as fast. So things like that, it does tend to have a ripple effect. So we just haven't seen it in a long time because energy has been pretty low in cheap for very long. But I would expect oil is just one of many different other sub-markets in the broader capital markets that are going to see the, call it the trickle-down effects.
Okay, before we wrap up here, I do want to ask you about SpaceX, because this is something that's on your radar today. This news coming out, Elon Musk is launching a massive joint venture between Tesla and SpaceX to build a custom semiconductor plant in Texas. Apparently, he's frustrated by semiconductor industry's slow pace. What do you make of this project? And, you know, Elon Musk and Tesla and SpaceX kind of stepping into this space?
Yeah, you know what's interesting about this conversation is that this might be the hardest engineering challenge that's ever been done. And the reason I say that is when you're trying to reverse engineer, copy, innovate on, doesn't really matter. The entire semiconductor value chain, that is rocket science and then some level of complexity and difficulty that you're working through. So this is along with SpaceX catching rocket boosters with chopsticks in the sky, level of hard. So vertically integrating semiconductors all the way down, I think is one of those things you have to watch out for, because there's a lot of market cap and a lot of industry that is built around ASML machine, which then goes into TSMC, which is then marked up by NVIDIA, which is then marked up by Microsoft, which is then sold to the end consumer. So there's a lot of margin there in that whole stack. And it cuts to the heart of the technology parts of the S&P 500, which is a lot, and along with the MSCI World. So this is a big deal if he can get this right. But it is also an incredibly tough undertaking as a whole.
Yeah, and obviously
it tells you the world needs more chips. That's
okay. That's what that tells you in the end.
That's what he's saying. That the world doesn't have enough compute.
Yeah. And obviously, like SpaceX, a private company, but for Tesla, this could be a bit of a boost for a stock that's been not doing as well, maybe, as one might think, one might expect, I guess, since the beginning of the year.
Yeah, I think a good way to think about it is the Tesla narrative has effectively shifted towards humanoid and embodied robotics. And that's the new, call it, vector of competition. And being able to co-design your own chips and have them integrate well with your own robotics is really the bet that's being made. It's just that the steps that go into it are deeply complex. But this should be a boost to Tesla on its, and a holding on to the, call it, the Elon premium. And same with SpaceX, which is expected to go public later this year. So my gripe with Tesla and SpaceX has always been you're paying a huge premium for Elon Musk, and I still think that's the case, but this is Elon basically backfilling that by trying to call to action by building some of the hard stuff internally within Tesla.
Trying to back it up. Okay, I take your point there. We will leave it there. Dan Rahinton, portfolio manager at IA Global Asset Management. Always good to get your thoughts. Thanks so much for joining us. Coming up, we will continue to follow energy and the conflict in the Middle East as Donald Trump says talks with Iran were, quote, productive, but Tehran may be preparing to raise the stakes. There are reports that Iran is planning to further restrict access through the Strait of Hormuz. We will dive into that right after the break. Iran has promised to further close the Strait of Hormuz in response to Trump promising to obliterate energy sites. CTV's Camille Karmali has more in this report.
Rescuers search for bodies in Tehran after Israeli airstrikes hit Iran's capital overnight. As the missiles continue to fly, so too does a war of words. New threats from Iran today saying it'll completely close the Strait of Hormuz, a critical channel used to ship roughly 1/5 of the world's oil, and that it would attack infrastructure used by Israeli and American allies if the U.S. follows through on its plan to bomb Iran's power plants. Saturday, U.S. President Donald Trump said he would obliterate Iranian energy and power infrastructure if the key shipping route isn't opened up to all countries by Monday night.
That's not going to go down with the Iranians. They are fighting for their lives, and this is just going to drag this war on into a new direction.
Right now, Iranian officials say the Strait of Hormuz is open to all vessels except for the ships of enemy countries, referencing Israel, the U.S., and its allies. On NBC's Meet the Press today, the U.S. Treasury Secretary not counting out sending in troops to do the job.
Will the administration use troops to secure the Strait of Hormuz?
As President Trump always does, he's leaving all options on the table.
Each and every day, you lose, just for oil, 20 million barrels a day.
But fears the short-term ripple effects could turn into waves of volatility that last months, drowning the global economy.
You're destroying stuff, producing assets, LNG trains, refineries, wellheads, ports. And so the market is also worried about how long will the damage take to repair.
Across Canada, drivers hit hard at the pumps with gas prices continuing to rise. The blockade half a world away also has farmers here feeling the pinch.
With the situation in the Strait of Hormuz, it's a big fertilizer producing region. It's really not a great time as farmers are ready to get into the fields here in the coming weeks.
Those already paying more for travel, waiting for when the war will be reflected on their grocery bills. The European Union's foreign policy chief held a phone call with Iran's foreign minister today, expressing the urgent need to open the Strait of Hormuz, saying they're now exploring diplomatic avenues.
That was CTV's Kamal Karamali. Coming up next, we will have more. Stay with us right after this. Welcome back. We're going to start off by taking a quick look at the price of gold on this Monday morning. It is down at the moment by more than 3%, but it has been pairing gains since a rough week last week, as we're seeing the price of oil dropping today, gold and silver both rebounding after those dramatic losses last week. And this comes as Donald Trump is postponing those energy strikes in Iran, saying that some talks between the U.S. and Iran are going well, and we're seeing gold rebounding ever so slightly this morning after, as I mentioned, look at that week last week. We'll keep watching the price of gold today to see what happens. But in the meantime, it has been affecting many Canadian mining companies, and shares of Canadian-based Orla mining were actually up, though, Friday after it reported a record gold production for its fourth quarter. So for more on this, we were joined earlier by Jason Simpson, CEO of Orla Mining.
Our conviction is that by 2028, we can get to 500,000 ounces, and we're pursuing 1 million ounces by the end of the decade. So the 300,000 ounce mark was important in 2025, and we've guided to a midpoint of guidance in 2026 to 350,000 ounces. So as I like to say, that takes us part of the way on the journey for Orla Mining.
There's a lot of different projects to talk about. So we'll start with the South Railroad project, which is showing some results. How critical is this asset for Orla's next phase? And what are you expecting in terms of future numbers? Yeah,
that's the important first asset to talk about this year, because we're beginning construction at that mine this year, continue through next, and it'll represent our third mine in the Orla portfolio. So that'll be the focus of our attention over the next 2 years. It'll add about 130,000 ounces per annum of gold production. Importantly, at very high margins. Another open pit heap leach, similar to the operation we have in Mexico. These open pit heap leaches are tremendously cash generative. The Mexican asset is what enabled us to graduate into Nevada and then eventually Canada last year. And so we look forward to bringing it online and adding to the annual production and cash generation of the company.
Let's talk about the Musselwhite acquisition. How has that improved production and geographic exposure?
Musselwhite was an absolutely transformative acquisition for us. It more than doubled our production, and as exemplified in our results, is now our largest mine and really is the anchor of our business. And so it will continue to produce over 200,000 ounces a year, added to the 115 that we produce in Mexico, midpoint of guidance this year. That's what takes us to the 350 midpoint in 2026. The interesting thing about the Canadian asset is that we believe that we could do two things there. One is extend mine life considerably, and the second is that we had many years to go and a lot more gold to harvest. And last year we demonstrated that. From underground, we clearly had indications and will be able to increase for many years the lifespan of Musselwhite. But from surface, we were able to push that gold mineralization out for 2 more kilometers, so effectively taking us out for many decades of cash generation from our Canadian asset.
There was also some new discoveries at the Musselwhite asset as well. Is that right? 2 kilometers below the original mine?
Yeah, it's actually an extension of the existing mine. So that mine has been producing through the great employees and stakeholders in that community for over 25 years. It's produced 6 million ounces of gold. When we acquired it from Newmont, we knew that we were acquiring a little over 1 million ounces, but we believed that it could continue even further than the 6 years that Newmont had outlined. And so we demonstrated that last year, drilling holes from surface some 2 kilometers away from the last mine working. We were able to intercept that gold formation that continues. So what does that mean for Orla investors? If 6 years and 6 kilometers of mining over the last 26 years, 6 kilometers has generated 6 million ounces of gold. We just added 2 more, so we've tripled the potential resource at Musselwhite. Again, emphasizing our conviction that we'll be there for a long time harvesting gold out of the Musselwhite deposit. The other discoveries are surrounding the deposit. There's gold that we've discovered on surface, almost unbelievably for such a legendary camp.
What's the cost, though, of continuing to mine in those deeper areas?
Yeah, that's an important feature of a Canadian underground mine. It is a different cost than an open pit heap leach mine like we have in Mexico and our building in Nevada. So certainly it's a different cost profile, but we believe we also have a strategy to reduce the costs. There's really 2 elements we'll focus on. More production clearly drops the cost per ounce, and we've already demonstrated that we're going to be able to deliver more and reduce the cost that way. But also by improving some of the infrastructure at the site, we actually believe we can reduce the total cost of the operation. But we're always going to have a remote fly-in, fly-out operation, an underground mine, and from that very nature, it will be one of our higher cost mines. But when you aggregate that with the 2 open pit heap leaches, we're comfortably into the first quartile of costs, and predictably at today's gold prices generating significant cash from all of our operations.
We are almost out of time, but I did want to ask you, just in terms of like the geopolitical factors around the world right now that might be impacting your company. You know, what we're seeing is the price of gold obviously has been dropping. How do you manage any kind of risks associated with things like that?
Yeah, so I'll answer that question from 2 perspectives. One is the revenue that we generate. I think most gold miners and my peers are comfortable in these gold prices. We are building a company that would be resilient at gold prices thousands of dollars lower than what it is today. So we would certainly like to maximize the revenue that we're generating and increase the value that way. But at $4,500 gold or $5,000 gold, we're making tremendous profits, and we'll have a company that survives at all parts of the gold cycle. On the cost side of things, and I've gotten a lot of questions about our fuel exposure and so on. You know, listen, wars are inflationary, tariffs are inflationary, and so we are not immune to inflation. However, each company has different exposure to it, and we use fuel as an example. In our operations in Mexico and Canada, the majority of our fuel is used in Mexico. We only have about a $25 million U.S. exposure to fuel prices. So therefore, in that example, you can see that Orla is not particularly exposed for fuel inflation and so on. So we are extremely comfortable with our cost of our operations to be able to produce free cash flow, as demonstrated in our results last night at all gold prices and in any macro inflationary environment.
Welcome back. The opening bells are ringing this morning at the NASDAQ. The Commercial Bank Group is ringing the opening bell at the New York Stock Exchange. Copa Holdings rings the opening bell, and the TSX Crombie Real Estate Investment Trust opened the markets this morning. It's time now for the first 15. This is BNN Bloomberg. Trading is just getting underway, so we will check in on the equity markets this morning, watching them closely. It's an interesting day. The TSX up so far to start the day by 0.7%. This is after the TSX saw some heavy losses last week. S&P 500, NASDAQ both trading above a full percentage point. NASDAQ up by 1.5%. We're seeing this today. Stocks, bonds rebounding as the price of oil drops as we're watching those latest developments in the Middle East. Donald Trump saying the U.S. had some good talks with Iran, which are apparently ongoing. So we'll keep watching that today. We're also watching some Canadian companies, of course. Orla Mining is one that finished top of the TSX on Friday after a strong fourth quarter earnings report. Obviously, we were just hearing from the CEO there. To start the day today, that stock down by 1.7%. But we are seeing, or we did see earlier this morning, the price of gold rebounding. So potentially a rebound for Orla Mining and its peers on the TSX later today. We'll be watching for that. Brookfield Infrastructure Partners, another company that we are watching today, up by 0.4% to start this Monday morning. It was upgraded to overweight at Morgan Stanley, citing the company's accelerating growth profile. And we're also keeping a close eye on Teck Resources. It's had a rough go. It's up by almost 5% at the moment, but this stock fell to its lowest in almost 3 months on Friday. You can see that drop off there since the beginning of March. So we'll look for a potential rebound later today. And we're also watching the news coming out of the U.S. where 2 pilots were killed and several others were injured late last night when a Jazz Aviation flight operated on behalf of Air Canada struck a fire truck on the runway during a landing at New York's LaGuardia Airport. We are now joined by Bloomberg's Janine Panzer for more on the details in terms of what we know so far about what happened here. Janine.
Yes, last night an Air Canada split flight carrying about 70 people on board crashed when it landed at New York's LaGuardia Airport with a fire truck. This resulted in the major travel disruption since last night. LaGuardia Airport will remain closed until at least 2 p.m. New York time today. Last I checked on FlightAware, at least 572 flights got canceled as of early Monday, so that's about half of its schedule. LaGuardia is a very important travel hub as New York's region third busiest airport, handling more than 30 million passengers each year, mostly on domestic travel. New York City Mayor Zoran Mamdani says that the city is in close contact with federal and state authorities as the response continues. We're also getting some details on the aircraft. Records show that it was a CRJ-900 regional jet. It is about 20 years old, according to Flight Radar 24. So runway incursions are more common than air collisions. The FAA report shows that in January alone, there were 97 such incidents at airports across the U.S. This also comes at a time when aviation safety is already under scrutiny in the U.S. Runway incursions are rare but not unheard of. The FDA said that it's almost, like I said, 100 of such incidents just in January alone. Air Canada teams are preparing to head to the site, and NTSB is in charge of this investigation and will provide update. More details expected as the investigation gets underway.
Yeah, and we have been hearing this morning some recordings from the air traffic controllers just moments before that crash. I'm sure a key component of that investigation, but we'll wait to hear more. That's Bloomberg's Janine Panzer joining us live this morning with the details. Janine, thanks for that. Coming up, is now a good buying opportunity for U.S. stocks? We'll have that conversation right after the break. Stay with us. Stocks and bonds are rebounding after U.S. President Donald Trump said the U.S. and Iran have held talks about ending the war. The Strait of Hormuz remains effectively closed for now, but our next guest believes that disruption will be short-lived and could be creating a good buying opportunity for U.S. stocks. Joining us now is Laura Wellen, Managing Director at UBS Private Wealth Management. Good morning. It's good to have you join us.
Good morning. Thanks for having me.
So we're hearing some developments this morning, but obviously we hear a lot of back and forth when it comes to this conflict. So why do you believe that this disruption in the Middle East will be short-lived?
Well, we started off this year really strong, and then when the Iran war started, we had plummeted returns pretty much across the board. So I think that there's probably good buying opportunity, both global and U.S. stocks. We'll have to see what happens after today's announcement with Trump. My guess is the market will probably react positively to it.
Yeah, he's speaking later this afternoon, as you say. We'll have to wait and see. So a good buying opportunity for U.S. stocks. Are there certain sectors in particular that you think are better to buy at this moment?
I do. I think tech was due for a little bit of a correction or pullback. So being selective on the tech side, I think is a great buying opportunity. I think healthcare space, definitely with the population and the aging and a lot of the AI stuff that's coming to the market quickly, is pretty fascinating. I definitely think industrials with the onshoring, infrastructure spending, and defense, definitely with the data center opportunity and the components that go into that. So I would look at those 4 sectors.
We know Iran media is saying Hormuz won't return to pre-war state even after this conflict is done. So I wonder what you make of that assessment and how that could maybe change what U.S. stocks in particular look like.
Yeah, so I think when you look at the news that happens daily, that's going to affect the short term, but this could create really good buying opportunities long term. Anytime we see disruption in the market on the U.S. side or international, we want to take advantage of that for our clients. So I think watching it daily to see where there's opportunity within those sectors and outside of that, we'll definitely take advantage of that.
Are there certain sectors that you think investors should maybe stay away from at the moment?
I think consumer spending is something that we're seeing cracks, especially in the lower end. 60 to 70% of people live paycheck to paycheck. And so watching, companies that back credit cards, things like that, I think you potentially are going to see a little bit of cash flow come in with the big, beautiful bill. People are going to get higher tax refunds than they've gotten in the past. So you might see short-term spending there. But I think that that's something that we have to be careful on.
Obviously, we saw last week the Federal Reserve decide to keep its policy rate unchanged at the moment. I'm wondering what you expect in the future, a couple months down the road, and how that will affect the markets.
Yeah, so interesting that it's kind of flipped in a week. That we're looking at cutting rates 1 to 2 times by the end of the year, and now we're talking about potentially not cutting at all and potentially raising rates. I know the European Central Bank is talking about cutting 2 or 3 times, so that could potentially create opportunity internationally. But I think, knowing that the Fed chairman is leaving and Kevin is coming in, it's going to be interesting to see if he follows with Powell's steps or he creates his own.
And you say your base case is that equity markets will end the year higher than today, and that bond yields will end the year lower. Why do you think that?
I think anytime there's global disruption, if you look back to the 1940s, you typically see 12 months later that the market's positive. So I think these, again, like I said earlier, create great opportunity for buying long term. But typically when you have geopolitical disruption, it doesn't last long term. So I think, if we can get to some resolution, we'll see that the markets will react positively to that and moving forward. I think inflation is still a real thing that we have to pay attention to. But I think bond yields will come down, especially as I talked about with the European Bank. But, we've locked in higher rates for the bonds previous, potentially hovering in that 3 to 3.5. We potentially could go back up to 4, especially when you're looking at the Treasury 10-year and you've kind of watched that move between, 4 to 4.4%. That's something we're closely watching too for clients.
And just lastly, your recommendation for long-term investors is stay invested. Can you elaborate on that?
Definitely stay invested. I mean, typically with these short terms, if you try to play it, clients do not do well with that. We love disruptions in the market. We're always looking for themes. We want to capitalize on different themes that we see coming forward. Potentially gold as a hedge here is a theme that we see. And so looking forward, we don't see capitalizing when you try to buy and sell quickly in these kind of times.
Okay, wait, sorry, yeah, continue.
We typically just see that it doesn't benefit them short term.
I said that was the last question, but I do have one more because you mentioned gold. So are you saying that that's a good place to be for investors as well?
Yeah, I think watching the dollar and the hedge on that, dollar had weakened. Now we're seeing a little bit of growth there. We've owned gold for clients for about 12 months. It's done very, very well. I think commodities is something here to watch and take advantage of long term. But I definitely see, opportunity there for clients.
Okay, Laura Wellen, Managing Director at UBS Private Wealth Management. Appreciate your time. Thanks so much for joining us.
Thank you.
Friday on Market Call, we were joined by Greg Newman, Senior Wealth Advisor and Portfolio Manager at Newman Group Scotia McLeod. His focus was North American equities, and his top picks were Invesco Trust, TransAlta, and AtkinsRéalis. And joining us today on Market Call is Jeff Parent. He's Senior Portfolio Manager at Castlemore, and his focus is technical analysis. So be sure to stay tuned for that. Just ahead, Quebec's Bill 21 is headed to the Supreme Court, a case with major implications for workplaces and employee rights. We'll have more on that right after the break. At the Ottawa airport on Sunday, many travelers said they are seeing higher prices, but most seem to be handling it with stride. CTV's Josh Moreno filed this report.
At the Ottawa International Airport, many are still traveling, even as costs in the airline industry rise.
We booked it a couple of weeks ago. We did most of it on points, but it was still pricey.
Tom Ertl is flying home to Fredericton and says booking closer to his trip came at a cost.
We don't do this leg often enough to really compare, but just generally flying is not for the faint of heart or for those with don't have deep pockets.
Others, however, say they're not seeing a big jump in ticket prices despite rising fuel costs, at least not yet.
Probably a concern, but we don't fly very often. We didn't really know what to expect, but it was fine, so we booked it.
Airlines, meantime, are adjusting. United Airlines announcing it's cutting 5% of scheduled flights through 2027 as higher fuel prices tied to ongoing tensions in the Middle East continue to drive up costs.
I booked that about 2 months back, this specific flight. But, with the situation currently in the Middle East specifically, it takes several iterations to finally decide on a timing.
With the price of jet fuel hovering around $175 US a barrel, there is some concern other airlines could soon follow suit. But for Ertl, that's not a concern, at least not right now.
It doesn't trouble me all that much. I've got lots of flexibility. I think the slashing of services and leg space and niggling little fees here and there for things, that's more of annoyance to me.
Josh Moreno, CTV News, Ottawa.
And stay with us. We're going to take a quick break right now. We'll be back in just a moment. Today, the Supreme Court of Canada begins hearing challenges to Quebec's Bill 21, or secularism law, that prohibits public sector employees or authority from wearing religious symbols at work. At the heart of the matter is the notwithstanding clause in the Charter of Rights and Freedoms that allows provinces and temporary legislation to override even when in violation of the Charter. So for more, we are joined by CTV's Judy Trin this morning. So Judy, what is at the crux of the Supreme Court of Canada challenging Quebec's Bill 21?
Lindsay, what we just heard from a group of civil society advocates is that this challenge before the Supreme Court will basically define what is liberal democracy in Canada. That is the way they are putting it, because this is a law passed by the Quebec government in 2019 that basically forbid people in positions of authority who worked for the government from wearing religious symbols such as the hijab, such as the Sikh turban. But for these individuals, freedom of religion, freedom of expression is also a charter right. What we know that has happened in Quebec is that Muslim teachers have not been able to find work. We know that Sikh officers have not been able to wear their religious symbols at work and have not been hired. So this is the case right now. Over the next 4 days, I just want to show you here, you'll see the overflow room in the lobby of the Supreme Court right now. That courtroom behind me is completely packed full of people who care about this case. Over the next 4 days, we are going to be hearing arguments from both the Quebec government as well as these civil society groups. Of course, the Quebec government argues that this law was essential in maintaining neutrality of the public service of government, and that's why they put it in place. Lindsay.
It's been such a controversial law, such a controversial story coming out of the province of Quebec. But as you mentioned, this is a defining moment for all of Canada. So can you kind of explain to our viewers once again, like how the outcome of this challenge matters for all of Canada and not just the province of Quebec?
That's right. Because in terms of how Quebec passed this law, they used the notwithstanding clause, which allowed the provincial government basically to override certain aspects of the Charter of Rights. So this hearing, this decision, this challenge before the Supreme Court will decide what those parameters are for provincial government. Just how much leeway do they have to use the notwithstanding clause to push forward an agenda that might discriminate against certain individuals that are protected by the Charter of Rights. And Lindsay, you know that the Alberta government has used the notwithstanding clause. The Ontario government is considering it in various aspects. So this will determine just how far they can take the notwithstanding clause. Lindsay.
Okay, Judy Trinh from CTV News. Judy, thanks so much for that. In a volatile market, a lot of pros talk about looking for value, but how can you assess which value stocks to actually buy? BNN Bloomberg contributor John Ehrlichman joins us with more on that. John hosts the investing channel Ticker Take on YouTube. So, John, good morning. Part of finding value involves avoiding so-called value traps. Is that right?
Yeah, absolutely, Lindsay. And Bloomberg did some great analysis of this because in a market like this, where we've already talked a lot about the stocks that seem like they've got big valuations and maybe have less value to offer, it's easy to start looking for stocks that would be described as cheap. Bloomberg actually has a great index where they look at so-called cheap stocks by looking at a larger index in the U.S., the Russell 1000, and then screening for companies that have better valuations based on good old-fashioned metrics, kind of a blend of different stuff, book value, earnings yield, dividend yield, the list goes on. But they make the point in a new analysis they put out today. What if you're getting stuck with a company that is cheap for a reason? So they do an extra layer of analysis to look at companies that have been showing improvements in profit potential based on what analysts are saying, the revisions to earnings expectations over the last 90 days. Which companies have the best revisions there? So they put those two together, and they found a group of companies that are not just cheap, but also are showing some potential for profit improvements, which I think is helpful in a market like this where people aren't necessarily sure where they want to turn. They want to get some good value, but they also want to make sure there's more meat on the bones in the form of profits because there's so many unknowns right now.
And so using those metrics you just mentioned, what would be some examples of stocks that kind of fit this framework?
Yeah, well, for any Bloomberg Terminal users, they've actually got some great analysis on this today, and they highlighted a few companies that screened well in both of these areas. I'll walk through a few names for you. In technology, even though, we talk about the most obvious Silicon Valley companies tied to AI, they noted that Dell, which has really benefited from the AI server boom, is a stock that is screening well for profit improvement and still looks cheap compared to a lot of stocks. That's a technology play. They also have an airline in there. Actually, they have a couple of airlines, but the one we'll highlight is United, which, you've got some references from the CEO because of what's been happening with oil that they're going to have to get ready for some unknowns. But if you look at what the company had been saying more recently, there are people that are paying up for premium seats. They have a loyalty program and a credit card program that has brought a lot of capital for the company. And so there is an expectation that the earnings will improve. Let's assume that the oil story doesn't stay as an unknown. And then they've got a company called Arrow Electronics on their list as well. And they're kind of like an Amazon for companies that need components. So they'll get those components or chips from technology companies. They'll get them into the hands of other industries. And they really have seen their earnings expectations skyrocket in the last 90 days. I will highlight, Lindsay, this stock is not recommended by a majority of analysts. Dell is, United is. That's another thing you might want to look at, how many street experts are putting their voice behind an individual stock. But nonetheless, some helpful analysis.
Yeah, no kidding. Okay, that's really interesting. John Ehrlichman, appreciate your time. Thanks so much. And you can find John's story on the BNN website and his Ticker Take YouTube channel banner. So, yeah, thanks, John. Okay, let's have a look at some of the early movers on Bay Street this morning. We're keeping an eye on the TSX today. It is up by more than a full percentage point. We saw some interesting movement on the TSX last week. Obviously, a lot of losses throughout the week, but the TSX starting the week off with triple-digit gains. So we're going to keep an eye on that. Almost every sector, though, is higher today, except for the energy sector. So the energy sector is down by more than a full percentage point at the moment. Obviously, we're seeing the price of oil drop today after Donald Trump has come out saying that the U.S. and Iran have been going through some very good talks, and Donald Trump is postponing some planned airstrikes for the next 5 days to see if the U.S. and Iran can come to some kind of deal. So obviously that's affecting the price of oil, which is affecting the TSX energy sector on the TSX today. If we take a look at some of the biggest losers in the energy sector on the TSX, Vermilion Energy is down by more than 4%, Peyto Exploration down by 3.7%, Whitecap Resources also down by almost 3% at the moment. And we'll take a look at U.S. markets as well. It's been interesting to see the actual turnaround, really, when it comes to markets. Stocks are up this morning. S&P 500 up by more than a full percentage point. Same with the Dow Jones. The NASDAQ up by almost 2% at the moment. Obviously, this latest development coming out of the Middle East affecting things on the markets. And obviously, the price of gold as well has been changing. Gold and silver both rebounding after some dramatic losses last week as Donald Trump postpones those energy strikes. Gold was rebounding, I should say, because right now we're seeing the price dropping by more than 2% at the moment. Earlier this morning, it was pairing some of those gains or losses that it saw last week, but we're seeing it drop a bit right now. And we'll take a look at the loonie as well. Some volatility this morning. It was briefly spiking after Donald Trump said those talks with Iran were, quote, very good. But right now it's up by 0.05%. So not much movement ever since the markets have opened. Just ahead, oil pulls back today. We will find out why with our next guest right after this. Stay with us. Hi there. Welcome to the second hour of The Open. Let's take a look at some stories we're following in the BNN Bloomberg newsroom. U.S. President Donald Trump says strikes against Iranian energy infrastructure and power plants would be postponed for 5 days following the start of talks with Iran to end the war. Trump also says the halt to attacks are subject to the success of ongoing meetings. Trump had initially given Iran until this evening to reopen the Strait of Hormuz, or the U.S. and Israel would start bombing the country's power plants. 2 Air Canada pilots are dead after an Air Canada Express plane collided with a fire truck shortly after landing at New York's LaGuardia airport last night. The pilots were killed on impact. There were 72 people aboard the aircraft, 41 of which were taken to hospital, with many in serious condition. Air Canada says it's cooperating with the Transportation Safety Board of Canada and the National Transportation Safety Board in the U.S. as they investigate the cause of the incident. Bloomberg News is reporting Sony is nearing a roughly $1 billion U.S. deal to sell a majority stake in its home entertainment unit to TCL Electronics Holdings. This comes as the Japanese company accelerates a shift away from hardware. The transaction would build on a previously announced joint venture that would see TCL take a 51% stake and oversee production of televisions under Sony's Bravia brand. We're watching the TSX today. It seems to be coming back after a rough week. Last week, it's up almost 2% at the moment. This comes as we also see the price of gold, which was spiking earlier today, obviously boosting the TSX. U.S. markets are up today as well, though, on the news that there could be some talks that are apparently going well, according to Donald Trump, between the U.S. and Iran. And we can see that reflected in the markets today. The Dow Jones and the NASDAQ both up by over 2% at the moment. And oil is pulling back after U.S. President Donald Trump is signaling a pause on further action against Iran. But is the market breathing too easy? Here to give his take on this is John Zechner, chairman and founder of J. Zechner Associates. Good morning. It's good to have you join us.
Hey, good morning, Lindsay. How you doing?
I'm good. So this is an interesting start to a Monday morning after a week last week that we saw in terms of the markets. Like, do you think that this is just a momentary blip, really?
Yeah, somewhat, Lindsay. I mean, it's almost hard to believe. I'm used to volatility when I do these Monday morning interviews, but this was something. When I got up this morning, U.S. futures, the S&P was down 100 points, and gold was down about 5 or 6%. And then suddenly at 7:30, it all reversed because of Trump's comments. And Saturday night, he's giving them a 48-hour ultimatum, and they've killed the leadership. What they've saying, there's nobody they can negotiate with there. And then suddenly this morning, talks are going well. Talks with who? We have no idea, and it's been extended. So it's, you can call it a talk or you can call it whatever, but it was Monday morning. I think he maybe looks at the market and says, this is too much. I got to say something to turn it around. So it's hard on that basis, Lindsay, to say this is, solved. I mean, there's so much ahead, and, this strait is far from being cleared out, and there's a lot, there's still much to happen. So, what are investors to do? You sort of got to hang tight, and I think play it down the middle. Don't sell everything, but don't go rush out and go way overweight stocks, and just look for opportunities. I think there are some spots in the market. We were buying into some of the metal stocks late last week, adding a little bit more to tech, and maybe leaning a little bit into the oil trade right now.
It's interesting, like, as you say, it's basically like whatever we saw last week or even early this morning, just take that and flip it, really, ever since the markets have reopened. There's such a reversal. You say you were buying into metal stocks last week. Why is that?
Well, I think some of this will be short-lived. I mean, when I look at it, gold has been under a lot of pressure, but gold faced, it lost 2 of its major tailwinds recently. I mean, the U.S. dollar has once again become, the ultimate safe haven currency in sort of geopolitical times. So it's risen. And then, U.S. dollar falling, U.S. dollar weakness for the past year and a half has been a big tailwind, obviously, for the gold and the metals markets generally. And on top of that, I mean, what you're seeing on the inflation numbers potentially, and the oil price is going to stop the Federal Reserve and other central banks from cutting interest rates. We heard all the commentary last week, and that was another big tailwind for the metals, is the fact that the interest rates were going to be cut later this year. So it took both of those ways. So I think a lot of the fast money pulled back. I think the central banks, who have been big buyers, are probably, they've got to evaluate the situations. They're sort of they're not knee-jerk reaction type players. So they'll be back buying again, but maybe not right away. Yeah, but at the same time though, the stocks have come down so much more than the metals. So yeah, we started picking away at a couple of gold names, a couple of copper names, and I just think I like buying when there's blood on the streets, when there's panic kind of thing. That's what you were getting in some of these markets. I don't think ultimately it'll be as bad as maybe some of the the worst visions of it are right now, but it'll take time.
Mm-hmm. And going back to, as you say, like, there's just so much chaos right now, and it's sometimes good to buy within that chaos. You've mentioned the U.S. cannot unilaterally end a war and declare victory. So what is it going to take to kind of wind this down and see maybe a little more stability in the markets?
Yeah, I'm going to steal a line from Helena Croft. I love that one. It takes 2 to taco, which is basically, I mean, Trump, he can't do what he did on the tariff front. He can't just unilaterally say, okay, I'm going to delay these for a period of time. I mean, he can say, hey, say we've won and stop the bombing, etc. But doesn't mean the Iranians are going to open up the straits. And like I say, I don't even know who they're negotiating with. I don't know if they know. So this will take a period of time, and it'll be a while. I mean, remember when they went into Iraq in 2003, the war was over almost on day one, but it took 6 or 7 years for them to get out. It was an elongated period of time before you can stretch it. I think in the interim, oil prices will probably stay a little bit higher, longer. I don't think we're quickly going back to that $60, $65 a barrel number we were at. We're not going to maybe stay at 90 to 100, but maybe we settle back in the 70 to 75 range. And on that basis, some Canadian oil stocks do look interesting.
Well, and that's a good point, right? I mean, like, can we go back to where we were before with so much infrastructure in the Middle East now damaged or destroyed? And also Iran saying that the Strait of Hormuz is not going to look like what it did before the war in terms of how much tanker traffic is getting through. So, like, can we really go back to where we were before in terms of the price of oil?
No, certainly not immediately, Lindsay. I mean, it could take years to get there, and they're going to have to go all to alternative channels. There's an opportunity for Canada to sort of do some better long-range planning on LNG and other things to be able to supply this. I think, a quiet winner in all of this that have been out of favor lately is some of the alternative energy stocks. I mean, wind and solar generally on a global basis are not going to be constricted by this, and yet they, as an alternative, they're looking interesting compared to some of the where the oil price is. So, there's always opportunities. We're seeing it all over the map. I've seen it in tech stocks lately too, because nothing of this is going to impact the rollout of AI and ultimately the implementation. And yet some of these stocks have been pummeled, for, even before this started, but, as this has been going on as well. So we were back buying Oracle last week, which we sold last October around $300. And now it's trading around 150. And we're worried about negative free cash flow and the valuation was high, and you've stripped a lot of that away. So, that's what the market does. It gives you opportunities to buy things, and then you sort of lean into things that worry you a little. I'd be a little more concerned, Lindsay, about the financials, because financials are big players in the bond market, and the bond yields have popped up, and, bond market is acting a little like 2022. So, and capital markets have struggled a little bit lately. So those have been great tailwinds for the banks, the financials. Those are going to disappear a little. So I would not be rushing out and buying the banks, Canadian or U.S., in this environment.
Interesting. Okay, so stay away from financials. You say you like some of the big tech names. You did mention earlier that you've got some core oil names as well, Tourmaline, Cenovus. Can you talk a little bit more about those?
Yeah, I just think the longer-term plays in Canada, like Tourmaline, ARC Resources, Cenovus. I mean, Cenovus is now going to get that MEG deal. It's looking really good because they got it at a great price. You bought it when oil was sort of $60, $65 a barrel. So to current those assets are looking, very, very good. So those core domestic oil plays in Canada look great. A little bit of natural gas exposure. I think natural gas is a better long-term growth potential because of its use and obviously in data centers and its the ability to access it more locally too. So, these are good. That's going to draw money back into Canada, I think. We're going to look at it on an international basis, international investors. So, okay, where can I invest in energy where I don't have a lot of geopolitical risk? And hey, Canada, it sticks right out. So, it may ultimately help us with the valuations, which have been under a lot of pressure for a number of years as everybody's exited the country. So, energy stocks here look like a good bet too, energy infrastructure. So, there's always places to go, but I don't think you have to rush into it all today. And I wouldn't, just because it's trading up this morning, it's not necessarily time to pile back in. Be judicious, look at your long-term targets, what are your asset mix ranges, and now we're probably neutral within that range.
And just before I let you go, I did want to get your thoughts on some of the indices like the S&P, the Russell 2000, NASDAQ 100 on Friday. Russell 2000 tumbled 10% from its peak. So we've been seeing some interesting stuff. Same with the NASDAQ 100. What do you think about that? Is this a mega cap resilience or a warning sign in the market?
You know what, Lynn, that's an interesting point because it is exactly that, mega cap resilience. They have almost like better than U.S. Treasuries have become the safe play because when you look at it, everybody was talking earlier in the year about how the S&P equal weighted was doing so much better than the S&P 500 because, all these other stocks were starting to play a little bit of catch up. And in the past month or so, or certainly when this conflict has gone on, it's been the opposite. I mean, the Russell and the NASDAQ are now in correction territory. As of Friday, they both dropped more than 10%. The S&P 500 had held in relatively well just because the big names, I mean, Apple, to a degree, Microsoft, NVIDIA, these very heavily weighted, didn't come down a lot. I mean, they're cash generating machines. They have great cash balances. And in some ways, they're probably better bets in terms of credit quality than necessarily the U.S. government or a lot of international currencies. So.
So many things to watch for. Okay, we'll leave it there. John Zechner, chairman and founder of J. Zechner Associates. Always appreciate your time. Thanks so much.
Thanks, Lindsay.
Still ahead, Canadian farmers are sounding the alarm on the ongoing fluctuations in energy prices and potential impact for food prices. We've got that conversation after the break. U.S. President Donald Trump may have hit pause on the conflict in the Middle East, but it's still impacting energy prices. Canadian farmers are impacted by the cost of fuel and fertilizer, and it may soon impact Canadian grocery bills. For more, we were joined earlier by Darren Shrosby, farmer and founder of 33/7.
fuel and fertilizer as a combination is pretty much where it's getting slightly tricky. So we're looking at about a $500 per ton increase in urea, which is a part of base fertilizer, and also a $250 a ton increase in dry nitrogen. So overall, that's obviously impacted the cost of inputs for the farmer. And the cost of inputs since the war started is about $40 to $60 per acre. So that directly translates into increased inputs, which obviously is going to trickle down to a more expensive product at the grocery store.
Hi, Darren. Have farmers been able to get more inventory lately? Have they? How is it going to impact them right now? Is there going to be a lag effect in terms of pricing going up, or are we going to see impacts right in the grocery store ASAP?
So I think there will be a lag effect for sure. There's no supply shortage. Farmers can store quite a lot of diesel, urea, nitrogen on the farms. So it'll be good for seeding. So we will get into the field with no problem, with enough nitrogen, urea, sulfur, phosphates, et cetera, et cetera. If this price continues to maintain in a high way, sort of at $40, $60 of inputs, increasing, it's going to definitely trickle down, but it'll take a couple of months to get there. So we're hoping that things calm down a little bit, and by harvest time, which is at sort of September time, we're back to status quo, which is not quite as bad as it is now. And you mentioned the $40 to $60 per acre, I believe that was. Do you know what that translates to a product at the store? It depends on what product. So is it canola? Is it wheat? Is it a grain or a cereal? It depends, and it fluctuates wildly on which product you're growing. So if you're growing canola or corn or soy, it's going to be a very different price to table. So we'll have to figure that out. So I'm not really sure what that looks like right now, but overall, it's probably going to be about a 10 to 15% increase in base commodity prices, which is good from an export perspective, but not so good for the end user at the table.
Mm-hmm. What can farmers do to offset some of these costs? Are they looking to improve technology? Are they looking for alternative solutions? You mentioned that there's going to be a lag effect. Is it going to be that material if the straits open up in the next few days? Could we avoid a lot of the problems here?
So I think, history often repeats itself or comes close to repeating itself. Remember when Russia went into the Ukraine for its shenanigans back in the day? We had a similar experience where, oil went up quickly, diesel went up quickly, et cetera, and it stabilized quite fast after that as the global supply market changed and adjusted to the new normal. So we're sensing that this will happen again here. As you know, Canadian farmers are extremely resilient. We're used to taking hockey pucks to the face constantly. So we will find a way around this like we do on most of our challenges. But in the meantime, it's not all doom and gloom. Like the Bloomberg Commodity Index is up 6% year of date. So that's been good. And we're expecting strong exports. The government's been great as well on the canola tariffs. They're down now to less than 15% on tariffs, which is excellent. So well done there. So we're super optimistic for a great season. And I think that the commodity prices will more than offset the input prices.
Very interesting. Are we expecting any further policy response from the government? What are you hearing from your contemporaries? Is there a potential for further cuts on tariffs or some kind of assistance from the Canadian government here?
Yes, there is assistance right now. The Canadian government has been really, really great and helpful for us. They have increased the ability for us to borrow up to $500,000 of assistance money based on input fluctuations. So that has helped a lot of farmers to be able to sort of buffer the current price increases. So we're grateful for that. Any concerns about potential shortages of products that you need, phosphate, things like that? If either of this were continued, I mean, who knows what's going to happen with it, and if there's extensive damage to some of the facilities that export this, any concerns about supply shortages and then having an impact on crops? So at the moment, thankfully, I think most farmers who I've spoken to up and down the chain, a lot of prairie guys, they're all stocked up. And we have, as of yet, not found any supply shortages. But obviously, if this continues, yes, we're going to run into shortages. And if there are shortages, then prices will increase dramatically. And that will be a very tricky thing for the consumer because prices will spike fast. So we're hoping that we have enough supply to get into the field, which I said I think we do as a general country, as a general rule. Hopefully this is good by harvest, because if we have severe diesel shortages by harvest, that's going to affect us getting the crop off. Combines are very thirsty machines, and they like to go through diesel at a rapid rate. So we definitely want to get this thing done and dusted, so to speak, by hopefully September.
All right, and I just want one last question before we go. With all these soaring prices, what kind of is this putting farms in danger of closing?
I think that there's a lot of pressure from various different angles that put family farms at risk. This certainly is one of them. Hopefully this is not the straw that breaks the camel's back. And as I said, farmers are extremely resilient. We built this country on our toughness. So hopefully the family farm can bounce back or stay in the fight, so that when prices do stabilize and, canola's up $1 a bushel, that kind of stuff, that hopefully will rescue us, will rescue the small family farm in or around harvest.
That was Darren Shrewsbury, farmer and founder of 33.7, with our guest host Barry Schwartz, CIO and portfolio manager at Baskin Wealth Management. Stay with us. We're going to take a short break, but we will be right back. Iran has promised to further close the Strait of Hormuz in response to Trump promising to obliterate energy sites. CTV's Kamal Karamali has more in this report.
Rescuers search for bodies in Tehran after Israeli airstrikes hit Iran's capital overnight. As the missiles continue to fly, so too does a war of words. New threats from Iran today, saying it'll completely close the Strait of Hormuz, a critical channel used to ship roughly 1/5 of the world's oil, and that it would attack infrastructure used by Israeli and American allies if the U.S. follows through on its plan to bomb Iran's power plants. Saturday, U.S. President Donald Trump said he would obliterate Iranian energy and power infrastructure if the key shipping route isn't opened up to all countries by Monday night.
That's not going to go down with the Iranians. They are fighting for their lives, and this is just going to drag this war on into a new direction.
Right now, Iranian officials say the Strait of Hormuz is open to all vessels except for the ships of enemy countries, referencing Israel, the U.S., and its allies. On NBC's Meet the Press today, the U.S. Treasury Secretary not counting out sending in troops to do the job.
Will the administration use troops to secure the Strait of Hormuz?
As President Trump always does, he's leaving all options on the table.
Each and every day, you lose, just for oil, 20 million barrels a day.
But fears the short-term ripple effects could turn into waves of volatility that last months, drowning the global economy.
You're destroying stuff, producing assets, LNG trains, refineries, wellheads, ports. And so the market is also worried about how long will the damage take to repair.
Across Canada, drivers hit hard at the pumps with gas prices continuing to rise. The blockade half a world away also has farmers here feeling the pinch.
With the situation in the Strait of Hormuz, it's a big fertilizer producing region. It's really not a great time as farmers are ready to get into the fields here in the coming weeks.
Those already paying more for travel, waiting for when the war will be reflected on their grocery bills. The European Union's foreign policy chief held a phone call with Iran's foreign minister today, expressing the urgent need to open the Strait of Hormuz, saying they're now exploring diplomatic avenues.
And that was CTV's Kamal Karamali. Well, we got more perspective on the global oil market and the impact from disruptions in the Strait of Hormuz with Kevin Book, managing director at Clearview Energy Partners. He began by discussing policy options that are under consideration by the Trump administration and implications for U.S. energy strategy.
If the cargoes we're talking about are the ones that are mostly headed to Asia, and about 80% of the Hormuz traffic from a crude oil perspective is going to Asia, then you still have to think about the global price implications of a shut strait. And that washes ashore on our coasts, despite where those molecules are going.
The president has said this quite a few times recently. We don't even use the strait, but this is a global market, of course. Could there be a world in which the president, I know he has said he's not interested now, cuts off exports from this country and creates some sort of domestic pricing structure?
Well, I think the news we heard this week is that they're not planning to do that. When we say exports, let's differentiate.
Would it even be possible?
Well, yeah, certainly I think could be possible. The powers in IEEPA might not be well suited to setting tariffs on counterparties, but it could certainly be used to block exports, and those things were mentioned actually in the Supreme Court ruling. But to sort of look differentially at products versus crude, I think one of the areas we should be asking is, what does this look like if this goes on for a few more months?
That's right.
Right. So right now you could say there's no atheists in foxholes. There's no free marketers in a supply shock.
Okay.
And so the administration is saying, no, we're not going to block exports. We're working on the supply side. We're looking at liberalizing these cargoes, these forward-positioned, sanctioned ships, and allowing them to go to markets they otherwise might not serve. But at the same time, you know, if we find that the prices keep rising intractably, and it's possible that they could, although today's news, we'll have to process that and see what the market thinks of it. Sure. But if you just extrapolate the crude closing price out to April 30th, you get to like 174 per barrel, thereabouts. Right? So, and then you're doing no work. Work into it with a little bit more modeling, you get somewhere between 100 and 174 based on demand elasticities. And so the high end of that range looks really high, essentially doubling the gasoline price at the pump. At that point, you have to ask, would they potentially look at products exports? Sure, okay. And they might.
You say there's no atheists in the foxhole. How about in the oil pits? Because traders have had a heck of a time the last couple of weeks getting their heads around this. And there was this initial thought that this will be short-lived. We're seeing through this, was the line by many analysts, and it has really felt differently over the past 24 to 48 hours. The introduction of this idea of ground troops potentially occupying Carg Island, the idea of maybe the strait being closed for weeks, if not months more. What are you hearing when it comes to sentiment among traders, and how much darker could this get?
I think there's a lot of interest in trying to figure out the answer to that first question. Is it a short war? It's already on the edge of not a short war, even if you look at it from the perspective of stopping today.
That's right.
And it's not stopping, obviously, today if we're talking about ground troops. So I think we'll see how that discussion plays out. But even if it did stop today, it's not a short crisis at this point. Right. We still have that lag time to get facilities that have been shuttered back up. Today, Fadi Birol, the executive director of the IEA, was talking about 6 months for restarts of fields that shut down and facilities that shut down gracefully. Even if it were weeks instead of months, it would still be weeks. And then the damaged facilities could be much longer.
Okay, so then this supply disruption will be at least weeks or months longer, to your point, even if the conflict ends today.
Yeah, although part of the
Would
mitigation...
the market price beyond that if it saw this war end or a ceasefire in place?
Well, the market looks ahead, and so to the extent that you could say that the strait was reopening, I think you could look at this very differently. But is the strait going to be reopened? And I think listening to the Admiral talking about the process for reopening the strait, that too didn't sound instantaneous to me, Joe.
$3.91 today, the average for a gallon of gas. That's the average, which means a lot of people are paying more than that, and while some are paying less, $4, I'm guessing, is around the corner. Weeks or months more of crude being shut in, or 20% being off the market, would mean what for gasoline?
Yeah, if we get to that 175, 174 number, that's essentially a made-up number. Let's be serious about this. Predicting oil prices is hard in the best of times, and price discovery is even harder in a war. But if we look at that, we're essentially doubling the pre-war price on a crude oil content basis. So closing in on a 6 handle.
A 6 handle for gasoline.
On a national average basis.
On a national average. Is there anything that the White House can do beyond releasing barrels from the SPR, which it's already done? We've knocked out the Jones Act. What else could be done on a policy level here in Washington, if anything?
Well, I think that, again, this goes to the will to intervene. And as prices rise, interventions do tend to intensify. We're already starting to see some price controls, some of them soft price controls around the world. That authority doesn't look obviously vested in the president's powers right now. But on the other hand, there's inherent Article 2 powers that could be attempted in wartime. So I think we have to look and see.
Coming up, we'll have your latest headlines and an update on the markets, and then we'll tell you who could potentially take over as Apple CEO Tim Cook's successor. That conversation next. U.S. President Donald Trump says strikes against Iranian energy infrastructure and power plants would be postponed for 5 days. This comes after the start of talks with Iran to end the war. Donald Trump also says the halt to attacks are subject to the success of these ongoing talks. Trump had initially given Iran until this evening to reopen the Strait of Hormuz, or the U.S. and Israel would start attacking the country's power plants. The head of the International Energy Agency is warning that the global economy faces a major threat because of the Iran war. Fatih Birol says the situation is very severe and no country will be immune to the effects of the war if it continues. He says the crisis in the Middle East has had a worse impact on oil than the two oil shocks of the 1970s combined, and a worse effect on gas than the Russia-Ukraine war. Meanwhile, 2 Air Canada pilots are dead after an Air Canada Express plane collided with a fire truck shortly after landing at New York's LaGuardia airport. The pilots died on impact. There were 72 people aboard the aircraft, and 41 people were taken to hospital, with many in serious condition. Air Canada says it is now cooperating with the investigation. And we'll take a look at the markets this morning. An interesting day, seeing some interesting reversals across the markets. The TSX is up by 1.8%, S&P 500 and the Nasdaq both up by more than 2% to start the morning. Seems as though this is fueled by that talk. Apparently, these talks that U.S. President Donald Trump says are happening with Iran, postponing some airstrikes on Iranian infrastructure. And we're seeing that kind of optimism reflected in the markets today. We'll keep an eye on that for you. Apple CEO Tim Cook doesn't want to talk about retirement yet, but that doesn't mean succession planning isn't happening at the tech company. And a hardware engineering executive who oversees development of the devices that generate 80% of Apple's revenue is emerging as a potential candidate. For more on this, we are joined by Bloomberg technology reporter Mark Gurman to break down the details. Mark, good morning. So what do we know so far about who this potential candidate is?
Yeah, good morning. Thank you for having me. So Tim Cook says that he can't imagine living without Apple. That doesn't necessarily mean he's going to be CEO of Apple forever. It just means he can't imagine not doing the job he's currently in. Cook turns 66 later this year. He will celebrate his 15th anniversary as Apple CEO later this year. But a changing of the guard is absolutely in the works. Whether it happens next year, the year after that, they're preparing for life after Tim Cook. And the center of the equation is John Turnus, the Senior Vice President of Hardware Engineering. He's 50. Of everyone on Apple's executive team, he would have the longest runway as CEO at Apple. Everyone else on that executive team is either too new, not fit for the role, or around the same age as Tim Cook, which makes it difficult for them to be his long-term successor. He runs the hardware division, so he leads development of the iPhone, the iPad, all of Apple's devices, and from everything I'm hearing, would be a great fit for continuity and also the potential of new businesses for the company.
Yeah, it's interesting. It sounds as though he's won the support so far of a lot of leaders at Apple. And I think you mentioned this, but at the age of 50, Turnus is kind of younger than many of the other potential candidates, which means he might be around for a bit longer. So if he were to kind of take the reins here, I wonder what this could look like for Apple in the future in terms of keeping this company and the momentum going.
I think it would be a continuity play. I think he's very much molded in the way of Tim Cook. I do think he has a Cookian eye for cost cutting. He understands Apple. He's worked there for about half his life. So it would be a pretty natural and easy transition for the company. He's got the charisma as well. He's got this bit of a younger attitude. I think he would, fit, better into the mold of the typical Silicon Valley CEO while still having a lot of those Cook-like attributes. So I do think it would be a pretty effective transition for the company.
For sure. Okay. Bloomberg technology reporter Mark Gurman reporting live for us this morning. So interesting. Mark, thanks so much. Coming up, Hot Picks. We will zero in on 3 U.S. midcaps to keep your eye on right after this. Stay with us. It's time for Hot Picks, and today we are zeroing in on 3 standout U.S. midcaps. Our next guest has Badger Infrastructure as his top pick, an excavation services leader with operations across North America. So let's get more now from Ryan Modesto, CEO and Portfolio Manager at I2I Capital Management. Ryan, it's good to have you. Thanks so much for joining us.
Thanks for having me. Throw a little wrench in things here, too. We're doing, it's Canadian names that are under the radar in the AI space today.
Okay, even better. So let's start with the first one then, Badger Infrastructure. What is it you like about that?
Yeah, so Badger Infrastructure is a hydrovac company. And if you're looking for companies with exposure to AI, this is a company that has infrastructure in their name. So they're benefiting a bit from that AI infrastructure build out. So the nice thing about this company is most of their fleet, all of their fleet is on wheels. So they can move to wherever the demand is. And this company, they're seeing demand in the US currently. And that's where they've moved a lot of their fleet towards, and about 88% of their revenues come from the US side of things. So they're already levered to good growth on the US. They're levered to kind of the infrastructure and AI build out play in US as well. They've been taking a bit of a hit or seeing some weakness recently on some CapEx spending that the company is doing. Markets don't like that in the short term, but longer term, we think it's good. They're obviously seeing the demand. They're leaning into kind of that demand they're seeing in the US, and their return on invested capital is about 11% annually. So any of that kind of additional growth that they're doing, investment that they're doing in capital spending, we think it's a good thing because they're going to capture kind of that 11% return over time.
When it comes to risks, like you mentioned that capital spending, obviously a lot of investors, we've been seeing that with so many companies who are coming out with this spending, investors are pulling back a bit, a little bit hesitant about that. Is that one of the biggest risks for a company like this, or what other risks are you watching for Badger Infrastructure?
Yeah, for sure. I mean, a weak economy means you're going to pull back on capital spending plans at the company level. Obviously, a recession, everybody starts to kind of clutch their pennies and their wallets a bit tighter. That wouldn't necessarily be a good thing for Badger. But on the other side of that, the AI investment seems to be kind of bucking that trend regardless of what's going on in the broader economy. So you could have a scenario where you have capital spending pulling back in other areas of the economy, but the AI investment trade still kind of keeps going. And Badger, I mean, not all of their business is exposed to this type of trend, but it should be a tailwind for them as well.
Okay, next up in terms of hot picks, this is an independent power producer out of Alberta, Capital Power. What is it you like about Capital Power?
Yeah, so Capital Power is similar with kind of that tangential exposure to AI happening in the US. There's a lot of required demand for energy to power these data centers. You need a lot of energy to power them. So the independent power producers are kind of stepping up to fill in that gap for energy demand that's happening. And Capital Power is doing exactly this. They're stepping up and working on an agreement to help the build out of a data center in Alberta. And they've also recently signed a $3 billion joint venture with Apollo Global to go seek out acquisitions in the US to kind of capture that demand that's happening in the in power demand overall. So that's good. And they've recently had their investor day, and they're targeting annual growth out to 2030 in adjusted funds from operations in the 8 to 10% range, which is a nice growth rate here. In terms of valuation, trading at 20 times forward earnings, which isn't horrible valuation. It's not maybe not the cheapest, but we don't view it as a very expensive valuation as well, with 4% dividend yield and a lot of transparency and visibility into their future revenue and cash flow profile, which kind of justifies a bit of a premium valuation here as well.
Okay, and lastly, WSP Global. Tell us about this one.
WSP is an engineering services firm. And the big story here is they made an acquisition of a company called TRC in the US, and TRC focuses on the power and energy segment, which, as we were just discussing, has a lot of demand right now because of everything that's going on with that AI infrastructure investment. Mm-hmm. So this acquisition is really just straight out of the playbook for WSP Global, where there's kind of a new growth area, and they go make a big acquisition of a company that kind of gives them like a premier position in that space. And we think they're doing that again with TRC. It's providing a long-term growth platform for them, but also should boost their growth in the short term. Meanwhile, this stock's trading about 18 times forward earnings, which going back to 2017 is a bit of a trough multiple for this company. So we think from a valuation perspective, WSP looks quite interesting.
It's so interesting when we're talking about these mid-cap companies, because obviously what we've been hearing since the beginning of the year in terms of small caps is this is the year for small caps. Do you think, and I know 2026 changes rapidly, there's so many developments every day, but do you think so far this might be the year for mid-caps and it would be a good time to be investing in mid-caps for that reason?
For sure. In fairness, we probably said that last year as well, but if the geopolitics can get out of the way, we think it's a really good setup for the small and mid cap space in general. They tend to be a bit higher growth, tend to be cheaper than large cap peers as well. So we think there's a lot of potential in this space.
And is there anything else you're watching for in terms of like potential rate cuts or rate hikes that could affect mid caps?
No, they will see something. So our kind of view is that rates will sort of slowly come down over time, but we think we're kind of past the rate cut story. We think was more of a 1 year ago, 2 year ago kind of story. Yes, if you get rate cuts, it's going to help things, but we don't think that you need rates to come down to drive the mid-cap space higher. It won't hurt, but we don't think that's kind of the main piece to make it work. It's just kind of fundamental earnings growth, and with a decent GDP economic growth backdrop, we think that these companies will do quite fine.
Okay.
Barring the geopolitical situation getting out of the way.
Of course, yes. Always have to watch for developments there that could affect basically everything on the market. Ryan Modesto, CEO and Portfolio Manager at I2I Capital Management. Appreciate your time. Thank you. Coming up, our next guest says that the Iran war is shifting from a war of choice to a war of necessity, and it is far from over. We'll dive into that right after this break. Welcome back. U.S. State Department veteran Aaron David Miller is now a senior fellow at the Carnegie Endowment for International Peace. He says Donald Trump's recent comments that he's considering winding down military operations in the Middle East contradicts expanding deployments and rising risks to global oil flows. He also is warning that the conflict is far from over. Take a listen.
We are now in a transitional phase from a war of choice to a war of necessity. And I think when the Iranians began their horizontal escalation and put at risk Gulf states' interests, and essentially they haven't mined the straits, but they've essentially created enough uncertainty where anyone's tankers that they don't approve of, the Indians are through, the Chinese are through, will be blocked. Essentially, we now have not just a confrontation between the U.S., Israel, and Iran. We have an international crisis to global oil, global economy. And I think, I'm not sure where the president is going with this, but I think we have weeks, if not months, of military deployments still in train. 2,500 Marines are en route from the Asia Pacific. There's talk now of significant talk of providing options to seize Kharg Island, which is the major export facility, 8 kilometers long, maybe 15 miles off the coast of Iran. And then you have the major problem of the Straits. How the president could wind this war down and basically say we've won, leaving the Iranians with the capacity to turn on and off global oil traffic, to me is extraordinary. It will not be a victory. Tactically, we've undermined Iran's capacity to project its power abroad, but you've left the regime in place with a stranglehold, a chokehold over the world economy. That's not a victory, and that's not an accomplishment now of the president's goals.
Well, as the president teases this idea of winding down our military efforts, it reminds us of the competing objectives that we could be presented with, and I've already seen some glimpses of between the U.S. and Israel. Aaron, I'm curious where your thoughts are on this, because there's been this conventional wisdom that the U.S. at some point achieves what it wants to, packs up its toys and leaves Israel to continue prosecuting its war. A lot of folks think that that would be impossible, that as long as Israel is intent on bombing or fighting with Iran, the U.S. will have to stay in the region. What do you think?
Yeah, look, I'll give you the bottom line here, Joe. I've worked for administrations from Jimmy Carter to Bush 43, and I'd throw in Obama and Biden. No American president that I worked for has more leverage over an Israeli prime minister that Donald Trump has over Benjamin Netanyahu, because Netanyahu's core objectives this year is to get reelected. It's not Iran, it's not Lebanon, it's not Gaza. It's getting reelected. He needs the president of the United States in sync and campaigning for him actively. So when Donald Trump decides, if he decides that the war is over, he'll pick up the phone and he'll call his good friend Benjamin Netanyahu, and he's going to say it's time to stop. And Netanyahu will have absolutely no other recourse but to stop. Lebanon might be a different story, but clearly there'll be no prosecution of Israel's war against Iran once the Trump administration decides that it's over. It's just we're a long way away from that happening.
You wonder how much of this rhetoric is simply a shell game, Aaron. We've seen the president suggest before, ahead of the Operation Midnight Hammer, that there were 2 weeks to follow. And then, of course, the jets were in the air. We know that there are a couple of amphibious ships that have already left California and other areas, including the South China Sea, steaming their way right now to the region with the idea potentially of occupying Karg Island. Does that sound like a war that's winding down, or is the president trying to take our eye off the ball?
I think it's PSYOPs, psychological operation. The president did this, correctly pointed out before Midnight Hammer. He did it again when he basically said that technical talks between the U.S. and Iran were to resume in Geneva, and he was sending Marco Rubio to Israel on a Monday. Well, the war started on Saturday. No, he's quite capable of creating this sort of distraction and deflection. Look, the major problem, major challenge now is we're going from standoff strikes, B-52s, B-2s, Tomahawk missiles, cruise missiles, to actually putting assets, men and women and American equipment in the theater of operation where they will be, under any potential circumstances, taking Karg Island, occupying the coastal areas along the Straits of Hormuz, a tanker war where the U.S. escorts tankers, which is going to require an extraordinary amount of military hardware. We're putting our assets now at risk. So far from retreating, far from getting out, we're in, I would argue, for weeks more of this, Joe. Weeks. It's not long.
Are you expecting troops on Karg Island tomorrow morning then? Would you be surprised?
Wouldn't surprise me if Israeli and American troops showed up in Isfahan trying to figure out where those 900 pounds of highly enriched uranium is in 18 to 30 scuba-sized tanks. But those must be buried deep underground. If we're going to get those tanks, you're going to have to plant yourself there. You're going to need earth movers. You're going to need to dig. You're going to need to secure that area. Karg Island is risky, but probably doable. The HEU rescue operation, I think, is probably more complicated. The point is, Joe, we're there, boots on the ground, ships in the sea, aircraft in the air. We're going to be there for quite some time.
Wow. Aaron, David Miller on Bloomberg. I'll have to ask you about this breaking news in a Pentagon press policy that was just ruled unconstitutional. I know this isn't your focus, Aaron, but as someone, to your point, who has spent time in many administrations, what do you think of this? Will reporters be moving back in?
I think this is extraordinary. It's great for Bloomberg. It's great for the New York Times. It's great for the free press. And it's another indication that, in fact, in this republic, there are really still, through the courts, constraints on what is clearly a extraordinary aggrandizement of presidential power. So it's a good day for Bloomberg and a good day for the free press.
Okay, we are going to take a quick look at the TSX before we wrap up here today. It is gaining after a really interesting week last week, up 2%, more than 2% at the moment. We're also watching the price of gold today. This is an interesting one. Gold actually entering bear market territory with a dramatic sell-off early this morning, falling more than 20% since its January peak. You can see now down more than 2%. We're continuing to watch to see whether there's more of a rebound. We did see a brief rebound of gold and silver early this morning, but now this sell-off. And then, of course, the price of oil plunging earlier today as Donald Trump saying he instructed U.S. forces to postpone all strikes against Iran for a 5-day period. You can see the price of oil for the first time in a while down almost 9%. That wraps up this edition of The Open. Morning Markets is up next with Roger Peterson. Stay with us.